Good afternoon, everyone. I welcome you all to today's webinar. We have with us Mr. Ravi Sarogi, who will be leading today's webinar. Ravi Sarogi is a co-founder of Sasmiti Advisors and the SEBI Registered Investment Advisor. He previously headed the fundraising and fund product development at Northern Arc Investment, formerly known as IFMR Investment. Prior to Northern Arc, he worked at the Institutional Equities Research Desk at IIFL Capital and JP Morgan. He has also worked with HSBC in their business intelligence team. He is a member of Professional Learning Committee at the CFA Society India. He is also a technical consultant to Dwara Research. He has also consulted with the Social Impact Investment Team at United Nations Development Program UNDP. He is a Master of Economics from Madras School of Economics and CFA chart holder from the CFA Institute US. This webinar is being organized under the Financial Education Initiative of the National Institute of Securities Market NISM, which is supporting today's session. The NISM is a public trust established in 2006 by the Securities and Exchange Board of India (SEBI), the regulator of the securities market in India. The institute carries out wide range of capacity building activities at various levels aimed at enhancing the quality standard in securities markets. Before we begin the session, I would like to share some important points with all participants. Questions will be taken at the end during the question answer segment. All participants will receive their certificates of participation in 3 to 4 working days. The recording of this session will be uploaded on the official NISM YouTube channel. Now, without taking much time, I would like to hand over the session to our speaker, Mr. Ravi Sarogi, sir. Thank you.
Thank you so much, the NISM team, for inviting me. Thank you so much to the participants for joining today. A very good evening to everyone. We'll be talking about what is factor-based analysis. So today's session, it's going to be about peeling back the layers, much like the image that you see of a genetic lab on your screen. The idea is to look beyond just headline return numbers and try to understand what is the underlying DNA of a mutual fund, or portfolio. Now, most mutual fund performance can actually be explained using just a few common characteristics or factors, and that's what we are going to explore today. So we'll walk through the theory, the models, and most importantly, we'll apply them practically to decode fund, performance. So let's, get started. So before we start, nothing here is investment advice. This is purely for educational purposes. We'll be using live data. We'll be using actual mutual fund names and performances, but please do not construe that as an investment advice. Always consult with your financial advisor. This is purely an educational webinar, not for any investment advice. So please keep that in mind. Okay, so let's start with a simple, question. And since cricket is in the weather and it's the flavor with the India, England Test match. So I have a simple question. So there's a game of cricket, and Team A has scored 230 runs, and Team B has scored 215 runs. And the question that we are asking is which team has batted better? Now, most of us would say Team A. After all, it has scored, more runs. And that's how most of us tend to judge performance, by looking at the headline number. Whether it's cricket or investing, we often focus on such headline outcomes: total runs, total return, without stopping to ask, what really went into producing, those numbers. Now, the problem is that these headline numbers alone don't tell us the full story. There's often a deep layer that we are missing, which is what we are going to do in today's, webinar. Here's the full picture. of the question that I asked you earlier. Now, Team A scored more runs, but it was made up of specialist batters. Most of the players in Team A were specialist batters, and you would expect them to put up a high score. Team B, on the other hand, scored fewer runs, but their lineup consisted mainly of specialist bowlers. And for a team of bowlers, scoring 215 was actually quite impressive. Now, when you bring team composition into the picture, what kind of players made up the team, your assessment of their performance changes. And it's just not the final number that matters, the context matters as well. So, similarly, in investing, we can't judge a fund purely by its past returns. We have to look under the hood. What are the characteristics of that portfolio? What did the manager cook up in their portfolios to earn those returns? And that is where factor based analysis comes in. And that is what we are going to be talking about today. Now, uh, as looking at the team's performance, uh, it helped you to judge that performance better when you looked under the hood and you saw the player composition. Similarly, when there is a portfolio, when you look under the hood and you look at the characteristics of the stocks that makes the portfolio, you will better be able to judge the portfolio's performance. Was it genuinely smart stock selection? Was it due to exposure to certain styles like value, momentum, small companies, or was it just market rising? Did the fund perform well simply because the market did well? So instead of relying on surface level numbers like past returns or star ratings, factor based analysis helps us dissect a fund's behavior and understand why it performed the way it did. So think of it as opening the bonnet of a car, or in this case, a portfolio, to understand what was the engine underneath that bonnet. Now, for undertaking factor-based analysis, we need to know two things, which is factors and regression. And of course, we have a lot of live examples in this webinar, but it'll be meaningless to go through those examples without understanding what factors are and what regression is. And I'll try my best to keep it very simple. Nothing here is rocket science. We'll keep it to the basics. Let's try and understand these two building blocks of factor-based analysis. First, let's get into what are factors. We'll take a quick, detour back into cricket, something we all know and love. So, if I were to ask you to evaluate how good a batter is, would you only look at the total runs that they have scored? Uh, Probably you would look at a much wider set of attributes. How many innings have they played? What is their average? How many 50s and 100s they have scored? And what is their strike rate? Now, these attributes tell you a complete picture about a batsman and about a batter and about their performance. So these are attributes that you use to describe a batter. And just like a batter has attributes like batting average, strike rate, a stock or a portfolio too can have attributes that influences how it behaves and performs. And these attributes are what we call as factors. So it's as simple as that. Factors are simply characteristics or attributes of a stock or portfolio that help us explain their return. Now, some of the most widely recognized factors are size, for example, whether the company is large cap or small cap, value, whether it's a value stock or a growth stock, profitability, how profitable the company is, momentum, how has the stock's recent price performance been, volatility, how volatile is the stock's performance. These are attributes of a stock or a portfolio that tell you something about that particular investment. Now, it's important to understand that for an attribute to be considered a factor, it must meet certain tests. First is it has to be persistent, right? That factor should persistently tell us something about the stock's return in the past. It should be pervasive. It should work across all countries, sectors, asset classes. It should be robust and not based on a very strict definition. It should be investable. That factor should allow you to construct a portfolio in which you can invest. It should be intuitive. There should be some economic rationale about why that factor is explaining the stock's return or the portfolio's return, right? So factors are really the DNA of the investment returns. They help us describe a portfolio or a stock. Now, just to take an example, one of the attributes of a stock can be that its name starts with the letter A, let's say. Now, that's an attribute. There are many stocks whose name will start with A. But is that a factor? No. That's not a factor because the alphabet, which is what the name starts with, that's not going to explain to us the returns of that stock. So factors have to be meaningful. Now, to truly understand factor-based analysis, it's helpful to step back and take a look at how it evolved. We're not going to go too deep into this, but some historical context will really, really help you. So we begin in 1964 with CAPM, which is the legendary capital asset pricing model. It was developed independently by Sharpe, Lintner, and Mosen. So CAPM really revolutionized finance because it said that a stock's return can be explained by just one thing, which is the exposure that that stock has to the market. What is the sensitivity of that stock to market? And this sensitivity was measured by a single metric, beta, which has since become the most popular, Greek alphabet, in finance. So CAPM essentially shared that stock returns or portfolio returns are determined by one single metric, which is beta, where beta is a measure of how sensitive that stock or portfolio is to market. But by 1970s, researchers started to notice that all is not well, with CAPM. In particular, I would like to highlight the research done by Hogan and Haynes, where they found out that low volatile stocks actually tend to do better, which was exactly the opposite of what CAPM says. So low volatile stocks or stocks that don't react much to market movements, which are low beta, actually tend to do well empirically. So I think what this research, and what is called as the low volatility anomaly really did was it encouraged researchers to go beyond, CAPM. And an outcome of that was that there was a breakthrough in the year 1993. Professors Frama and French, they introduced the three-factor model. So they added size, which is small versus large companies, value, cheap versus expensive stocks. So they added size and value to the market factor. So suddenly we had a better explanation of stock returns. So not just market movements, but also company characteristics. So in 1997, Mark Carhart, he introduced a fourth factor, which is momentum, of course, inspired by the legendary work done by Jagdish and Titman in 1993 for momentum. So in 1997, momentum was added, as a factor. And finally, in 2015, Pharma and French expanded the model to introduce a total of five factors. They added profitability and investment to the pool of factors. So together, we now essentially have six factors, and these are the factors that we'll be using as part of this webinar as well. These are the six factors: market, size, value, momentum, profitability, and investment. These are the most prominent factors that are today used. Now, the reason we care about factors so much is that from factors, we can construct, factor portfolios. And then we can measure the return that these factor portfolios have earned, which is what is called as factor returns. And we can then compare these factor returns with the returns that the mutual fund has earned, any mutual fund that you're interested in analyzing. We can compare these factor returns to the mutual fund's return. And that tells us a lot about that mutual fund scheme. And we'll actually see live examples of what is the kind of information that you can glean from an analysis like this. So the first step is to convert factors into factor portfolios. So for instance, if you are studying the value factor, we sort stocks based on metrics like price to book ratio. So you can then form a portfolio that is long on the cheapest stocks, which are essentially value stocks, and short on the expensive stocks, which are essentially, could be growth stocks. So once we build such portfolios, we can track their performance and arrive, at the factor, returns. And I want you to hold on to that thought, because these factor returns will be very, very useful when later on we'll be doing, our analysis. So essentially, you can construct multiple factor, portfolios. As many factors there are, so many more factor portfolios, can be constructed. Uh, and, we will, of course, not have to build these factor portfolios. You can access these factor portfolios and the returns from InvestPar. This is a factor library maintained by Rajan Raju. It's publicly available. I have provided the link. Using that link, you can actually get historical data of the different factor returns, which is useful for doing a factor-based analysis. Okay, so now we have reached, to the heart of, the factor, based analysis. So on one side, we have, factor returns. So these are returns that are earned by the factor portfolios we discussed earlier. On the other side, we have the mutual fund that you're interested in and returns of those mutual funds. So we have factor returns at one side, mutual fund returns on the other side. Now comes the key step. We use the technique of regression to compare these two sets of returns. So think of it as overlaying two different stories. One is the story told by the market factors and the other factors. The other is the story told by the mutual fund's actual return. And the regression tells us how closely these two stories match and which part of the return is coming from where. So this is all that there really is to factor-based analysis. So just keep in mind, you have factor returns from factor portfolios. Factor portfolios are stylized, illustrative, sample, hypothetical portfolios that are constructed to capture different stock attributes. At the other side, you have mutual fund returns, and you use the technique of regression to bring these two together and to get insights about the particular mutual fund scheme that you're interested in analyzing. Now, I know that the word regression might sound a bit intimidating, but it's actually quite simple when you think of it visually. So imagine you have a set of dots on a graph. So this is called a scatter plot. So each dot represents a pair of number. Each dot has an X, Y coordinate. Now, what regression simply does is it plots a line through that graph, a line of best fit, which is that line which best captures the relationship in that scatter plot. It's a way to say, and on average, as X moves, how does Y move? The slope of the line tells us how sensitive the relationship is between variables. So regression is simply a tool. It's like a ruler that helps you measure the relationship, and the strength of that relationship, the direction of that relationship between two or more variables. So that's all that there is to regression. And I think by now you would have probably guessed that the reason, the relationship that we are interested in a factor-based analysis is between factor returns on one hand and mutual fund returns on the other hand. Again, just to explain the concept of regression, this is a plot. It's a randomized hypothetical plot. There is some mutual fund scheme's monthly return that you have plotted on the x-axis, and you have plotted the return of the value factor portfolio on the y-axis. So let's say you're interested in understanding whether your mutual fund scheme's monthly return is related to the monthly return of a value factor portfolio, right? So you have plotted these monthly returns of these two sets of investments into a scatter plot. Just by looking at this visually, you know there is some relationship. It appears that there is a linear, direct relationship between these x and the y-axis. But when you just look at it visually, you can't quantify that relationship. What regression simply does is put a line on that scatter plot and exactly quantifies the relationship between x and y. So here you can see the regression output is an equation which actually relates x and y. And there's a metric called as r square, which is 0.831. It means that this line is able to explain 83% of the scatter plot that you saw. Of course, not all of those dots fall on the line. So, the r square will be close for a good regression. The r square will be close to 100%, but it will never approach 100% unless all the dots, are on that line. So 83% r square is actually a very, very good regression. It shows that this line is able to very well capture the relationship between these two variables. So now with that background about factors and regression, let's quickly take a look at the process that we'll be following for undertaking the factor-based analysis. So step one is we start with the monthly return data of a mutual fund, whichever mutual fund you want to analyze. Step two, we collect the monthly return data for a set of factor portfolios like market factor portfolio, size factor portfolio, value portfolio, momentum portfolio. Now, where will you get these returns from? Like I described, in the InvestPa's website maintained by Rajan Raju, he's calculated all of these factor returns for us, which you can freely download. We then run a regression of the fund's excess return against the return of these factor portfolios. By excess return, I simply mean, a return where we have netted off the risk-free, return. And the regression output gives us very, very rich insights, which we'll, shortly see. It tells us which factors the fund is exposed to, how strongly it is tilted towards each, how much of the fund's performance can be explained, by these systematic factors. In other words, it shows us which styles or traits the fund is mimicking, even if the fund itself doesn't say so explicitly, right? So this is the power of factor-based analysis. It lets us reverse engineer, what's really driving performance, and it separates skill, from style. I think one way to think about factor-based analysis is if you look at a prism, if you pass light through it, it will split that light into 7 colors. Factor-based analysis is something similar. It's a tool. You pass mutual fund NAV data through it, and it will split that NAV data and tell you about what's really driving performance. Okay, great. So that's enough theory for now. So let's shift gears and let's look at some real world examples. So we have covered the foundations, what factors are, how factor portfolios are constructed, what is regression. So now it's time to bring all of this to life. So we'll take you through a few examples, case studies, where we'll run actual factor-based regression and interpret, the results. These examples will really help you connect the dots between whatever we have discussed, so far. So just a note before we start this section, we'll be using actual fund data, actual fund names. These are not investment recommendations. Most of these funds were chosen on random. This is not a value judgment on those funds itself. This is purely for your educational purpose. So let's begin with a basic CAPM. So CAPM is the most basic model to use because it only has one factor, which is beta, which is the market factor. So let's begin with a basic CAPM analysis of ICICI Prudential Value Fund. Now, it's a simple regression where we are trying to explain the mutual fund's return using just one factor, which is market return. So on the left side of the chart, which is this blue bar, that's known as the intercept. That's the alpha. So if you want to understand what is the alpha that has been generated by this scheme, you look at the intercept. So that's about 0.62% per month. So this analysis was done on monthly data. So that's 0.62% alpha per month. And it is statistically significant. So you see 3 stars in front of that 0.62 number. So more the stars, the better. The maximum stars there can be is 3. So it means that the regression output and this coefficient is highly statistically significant. I mean, there is a lot of certainty attached to that coefficient. So the alpha is 0.62% per month. This means that the fund has delivered some excess return even after adjusting for the market risk. On the right is what you see the market beta. So after removing the market beta, still, there is alpha that the fund has generated. The market beta is about 0.75. So this tells us that the fund moves in the same direction as the market, but not as aggressively. So a beta below 1 means that it's less volatile than the market. Beta of 1 would mean that the fund moves exactly in line with the market. Beta more than 1 would mean that the fund is more sensitive than the market. If market goes up and down, the fund will gyrate even more than the market. Now, the R square of this regression is 83%. So that's 0.83. So 83%, which is very good. It essentially tells you that 83% of this fund's return can be explained just by one single metric, which is beta, which in this case is the market. So far, so good. But CAPM only tells you part of the story. It assumes that the market is the only driver of returns, which we know is not the case. So let's dig deeper and see what happens when we add more factors, to the model. Now, this is where it gets more interesting. So, we've applied a more advanced lens. We are now using the Pharma French 5-factor model with momentum. So this is a more nuanced model. So on this chart, you can see that funds exposure not just to the market, but also to 5 other factors that academic research has shown influences returns. So first, let's look at you know the we can look at the market return. The coefficient is still strong, 3 stars, a strong relationship, 0.73 coefficient, so very close to what we saw in CAPM. In CAPM, we saw that as 0.75. So this confirms that the fund broadly moves in line, with the market. So next, let's look at SMB. SMB is just a technical name for the size factor. So this factor captures the fund's tilt towards small cap, stocks. So the coefficient is negative, and it is statistically significant. So this means that ICICI Pru Value Fund is primarily a large cap, fund. Next, look at the HML factor, which is the value factor. And this is where things get really, really interesting. The exposure is plus 0.25 and statistically significant. We have 3 stars, indicating that the fund has a very, very clear tilt towards value stocks, and which actually aligns perfectly with its label as being a value-oriented fund. So this fund does come up, has a significant loading of the value factor, which is statistically very, very significant. Which is exactly what we would expect in a fund which calls itself a value fund. The fund also loads positively on CMA, which is the investment factor. It suggests that it prefers companies that invest conservatively. That also aligns well with its value theme. The exposure to profitability and momentum are both close to 0, and they're not statistically significant, which means that those factors don't seem to influence the fund's return, which is quite fair, because value and momentum are inversely related, or at least not correlated. So the value factor is statistically significant, means the momentum factor would not. The intercept, or the alpha, has dropped to 0.36%. Now this is interesting because in the earlier CAPM model, you saw that the alpha was about 0.61%, right? Now, it's important to note here that in CAPM, when you're only looking at market beta, some of the style drift is actually getting captured in the alpha, which was 0.61% there. But once you start introducing more factors, the alpha starts getting explained by these other factors. Like, for example, here it's getting explained by the value factor and the investment factor, which is why the intercepts value has come down, which is it's now come down to 0.36% per month. Also to be noted is the significance level of that alpha has come down. So now we only have 1 star against the intercept. So this tells us that much of what looked like alpha earlier was actually exposure to known factors. Finally, in fact, when we look at the R square has gone up to about 90%, which is fantastic. It is essentially telling that this model explains 90% of the return that this fund, earns. So we have really uncovered a much clearer picture of what's really driving performance, in this scheme. So let's turn to another fund, Quant Active Fund. This is a multi-cap, fund, 50% large cap, 25% mid cap, 25% small cap, typical, multi-cap, fund. What we are seeing here is this is a simple CAPM regression. The market beta is 1.05 and highly statistically significant. So this fund actually moves pretty much in line, with the market. So beta of 1.05 pretty much means this fund moves in tandem, with the market. The intercept is 0.21%, but it is not significant. There is no star. So there is no strong evidence of alpha generation happening here. The R square is 0.78. Okay, that's good enough. Anything above 75 is good enough, but of course not as high as what we were seeing earlier. So CAPM explains about 78% of the funds return. Probably there are other factors at play. So let's look at the Pharma French 5-factor model, for this fund as well. Now we see that the R square has gone up to close to 89%, so close to 90%. So which means that this is a much better fit. We are able to explain a lot more returns, in this fund by using the Pharma French 5-factor plus momentum model. So let's walk through the coefficient. The market beta is 1. This is a fund which moves absolutely in line, with the market. The SMB, which is the size factor, is at 0.15 and it's statistically significant, 2 stars, which means that this fund does have exposure beyond large cap. So there is mid cap, small cap, of course, which is there in this fund. HML is 0.18. Again, none of these coefficients are statistically significant. The only significant factor apart from size is momentum. So there is 3 stars. There is a positive loading of 0.37, of momentum in this fund. So this tells us that this fund has a clear, momentum tilt. It does favor stocks that have recently, performed well. The intercept is negative at 0.37, so which means after accounting for these factors, there is no evidence of excess return being generated by this fund beyond, what is explained, by the factors. Okay, so now that we have seen, individual fund diagnostics, let's take it a step further, with a case study. So we are going to compare two of India's most well-known large cap funds, HDFC Top 100 and Axis Blue Chip. The names of both these funds have recently been changed. It's HDFC Large Cap and Axis Large Cap now, but we will stick around with the old names. So these two funds, they offer a rich contrast, in their stated investment styles, how they behave, and what is also actually revealed by de facto analysis. So on your screen, you can see the performance of these two large cap funds, Axis Blue Chip and HDFC Top 100 from the period 2017 to 2023. So I've taken that period. Between 2017 and 2020, Axis Blue Chip was significantly outperforming HDFC Top 100. So delivered an impressive 20% CAGR compared to HDFC's 11%. But then came the reversal. It's as if to say something happened and the numbers just flipped. Between 2021 to 2023, the situation completely mirrored itself. HDFC Top 100 significantly started outperforming. It earned 23% CAGR, whereas Axis, earned just 10% CAGR. So what really explains this? What was going on? And did one fund manager's stock picking skill suddenly shift to another manager? So let's dig deeper with factor-based analysis and see what do we uncover here. So we'll be using the Pharma French five-factor model, for analyzing these two funds. Now, before jumping into the factor loadings and the coefficients, so let's take a quick look at how well the model fits the data. So what you're seeing here are two time series plots, one for HDFC Top 100, one for Axis Blue Chip. So we compare the actual excess returns of the fund with the returns predicted by the factor model. So the blue line represents the actual, monthly excess return. And the orange dotted line is the prediction by the regression. You can see how well both these lines track each other, meaning that the model is doing a fantastic job of explaining the returns earned by these funds. Is also confirmed by the R squared values for HDFC Top 100. The R square is close to 95%. So the Pharma French five-factor model plus momentum explains 95% of HDFC Top 100's return. And for Axis Blue Chip, that number is closer to 90%, which is also fantastic. So in plain English, the factor-based analysis is not some elegant theory, in academia, but it's extremely powerful in practice, and it's evident in how beautiful the model fits, the actual data. So this is the regression outputs for these two funds. At first glance, we see that both the funds have high market beta. So that's the blue bar, 0.92 for HDFC, 0.85 for Axis, both statistically significant. So both these funds are heavily influenced by the overall market. That's expected. But look closely at the value factor. The HDFC Top 100 has a significant positive loading of 0.2. Again, highly statistically significant. While Axis Blue Chip has a slightly negative and insignificant exposure to value. Right. So this tells us that HDFC Top 100 has been running a value strategy, whereas Axis Blue Chip has not. And this actually explains a lot. We know that value as a strategy did not do well between 2017 and 2020, and that explains HDFC's underperformance. After 2020, value made a comeback, and the tables turned. HDFC fund started shining, and Axis started to lag. So what seemed like a sudden reversal is actually very well explained by changes in factor performance and by looking at the style drift, and the style tilt in both of these respective, funds. So both funds also have negative SMB loadings, absolutely expected. Both of these are large cap funds. So the size factor is coming negative in both, and that too very, very strongly, significantly. So Axis Blue Chip, it shows a significant positive exposure to the profitability factor. HDFC Top 100 shows a significant negative momentum tilt, which is also statistically significant. And so the key takeaway, here for us is you can really decode a fund's true investing style. And the magical thing is the only thing that you need to do this analysis is the NAV data of the fund, which is freely and publicly available. If you were to replicate these kind of insights by not using factor-based analysis, it'll be very difficult to do that. What you'll have to do is you'll have to look at the holding statements of both these funds. From that holding statements, you'll have to see the individual stocks and then take a call on which fund is choosing stocks based on value, which one on growth, which one on momentum, which one on profitability, which one on investment. And you will actually have to look at those fund constituents not just for 1 month or 1 quarter. You will have to look at those constituents for your entire period of analysis. This can be very, very challenging and practically impossible for a retail investor to do. The reason why factor-based analysis is so powerful is because you just need from your side only one input, which is the fund NAV. The factor returns data has been calculated by many sources. You can use any that you like. The factor returns are available as long as you have your funds returns and you have a tool. We have a tool which we can showcase. And that's all. And you can replicate this analysis yourself. So to sum up, factor-based analysis, it goes beyond returns. It helps you understand why a fund performed the way it did. Right? Not just how much it returned. It reveals true style. It identifies hidden tilts, that aren't visible. Otherwise, you may not be able to see these tilts from the fund's marketing material. It distinguishes skill from strategy. Is alpha masquerading as beta? It'll tell you. It helps separate genuine manager alpha from exposure to known risk, factors. It improves peer comparison. It allows you to do apple to apple comparison by controlling for style differences. It protects against style drift. You can do a rolling factor-based analysis to see whether a value fund consistently maintains exposure to the value factor or not. Right. And it allows you to better your fund selection and betters your, monitoring. We get a lot of questions. This is all great. Where can we do this? We have a tool on our website. It's free, just for educational purposes. You just need to upload the NAV data of the mutual fund you're interested in. Click on run analysis, choose your factor models, and you get all of the statistics and the metrics that we discussed, in seconds. So you can use, tools, either this or others, for doing this analysis yourself and making better investment, choices. Great. So that's it. Thank you. Questions are, welcome. Okay, so I'll pull up the Q&A box. If you have any questions, please populate it there. We have some time available with us, and I'll try and take as many questions, as possible. Okay, so there's one question from Prathamesh Adhikari. Why are we talking about excess returns and not actual, return value? So the way factor analysis is done is we remove the risk-free return, because the excess return is what investors are really interested in. The risk-free return is readily available. So you're interested in knowing what is the return above the risk-free rate that you can earn. And the convention is to use excess returns over risk-free rate and not the actual, return, value. Yeah, so it's a similar question again from Prathamesh, why the excess return is over risk-free rate and not some other, benchmark. Like I explained, we are interested in understand from an investor point of view, the idea really is what is the return, that we earn over the, risk-free, rate of return. Okay, so we have a question from Pulkit Gupta. I had a question. How can we say a 0.25 value factor means a strong value exposure? Isn't a number close to 1 indicated strong affinity towards a factor? So the way you measure whether a value, any coefficient in a regression equation is statistically significant or not is by looking at its t value or the p value. That essentially tells you that the relationship that we are seeing between the dependent and the independent variables, is that out of chance, or it's not out of chance. You could always observe a relationship between two variables that's purely out of chance. So when we say that something is statistically significant, we are trying to see at a very low probability what is the what is the case when the relationship between the X and Y is not coming out of chance, but is actually deterministic. So we look at p-values. So in our case, when we had 3 stars, those indicate a p-value of less than 0.01, so less than 1% chance of it being purely out of chance. So isn't a number close to 1 indicate strong affinity towards a factor? Not really. Of course, the larger is the coefficient, the more is the relationship. But you can have a case where the coefficient is small, but the relationship is still statistically significant. So the coefficient tells you the magnitude, the absolute, so if value, returns were to change by 1%, what would be the corresponding impact on the mutual funds, return? Uh, Next, if the intercept is negative, so this is a question by Japesh Thakur. If the intercept is negative, what does it imply? Does it reflect the relative non-performance of that particular factor? So the intercept measures the alpha. So after you have put in your regression equation the different factors, whatever is left is what the manager is bringing on the table. So all the other style inputs into that management is being captured by the factor loading. What is unexplained is the intercept. So that's essentially what the manager is bringing on the table. So the intercept is interpreted as the alpha, as the true alpha. The fund could still have alpha, but after removing alpha, which is explained by the factors, what is the balance? So if the intercept is negative, it means the fund is not earning an alpha, and maybe that alpha is actually being captured in the different factor loadings. So how to identify factor cycles? Are these fixed? Sorry, but the question is not clear. But if you're referring to how do we know which factor will perform better or not, of course, that's a very difficult thing to do. Shrishti Rao mentions, how does it help me in selecting a mutual fund to invest in? It helps you to select a mutual fund because it tells you more about that mutual fund. It's a bit like if you were to purchase a car, uh, you wouldn't just want to know whether it's a Maruti or a Hyundai. You would want to know, what's the, horsepower, what's the powertrain, how does what is the different characteristics of that car across the metrics that you're interested in. So it just informs you much more. So for example, the reason why factor-based analysis can be very, very helpful is uh, if you in your portfolio, if you already have a significant value exposure, you may want to, from a diversification point of view, invest in a mutual fund that brings something else to the table. And that only becomes evident through factor-based analysis. What is that mutual fund really bringing on the table? So it helps you, do proper portfolio construction. Second, it helps you to contextualize, information very, very well. So for example, when the HDFC funds were not doing well because value as a strategy was not doing well, you could make a case that the funds are not doing well because uh, value is not doing well. And in fact, if value is not doing well, and if a manager is true to their style, you would actually exactly expect that. So it allows you to better contextualize that performance. And if we know that different things work in the market at different points of time, so it will reduce your portfolio turnover and turnover if you are better able to understand why certain funds are performing the way they are performing. So factor-based analysis can really, really assist an investor and an advisor, in constructing a portfolio. Japesh Thakur had a question that, this is rear view. We are looking at historical data. How does it help you make better investment decisions? I think, my earlier answer explained that. Do I have to put all MF and find the closest prediction? You can, whichever mutual fund you're interested in, you can run a factor-based analysis on that and interpret the output and use it as you deem fit. FF5 full form, that's Pharma French five-factor model. Uh, okay. Okay, this is important to cover. What are the limitations of the Pharma French five-factor model? Or in fact, what are the limitations of factor-based analysis? There are limitations. At the end of the day, this is a model. There is regression involved. There are portfolios involved. These factor portfolios are hypothetical portfolios. You really need to look closely at what is the definition of that factor portfolio. How was that factor portfolio constructed? So for example, in our market, the top 100 stocks are large cap. Whereas in the case of a factor portfolio, they could be using some other cutoff. So there are limitations in terms of the, factor model. For example, uh, you know, even if a fund is showing a factor loading to a certain factor, you may want to then replace that fund with that factor portfolio, but that depends on whether there is an investable product in that market which gives you that factor exposure. So, I think any analysis toolkit will have limitations. Factor-based analysis also has limitations. It's just important to be aware of those limitations and accordingly make inferences. How reliable is the InvestPar factor data library? As far as I'm concerned, it's the best. Of course, you can explore and take your own judgment, as well. It's a data library which has been made exactly how Pharma French do it in the US for the US market. So it's very well constructed, and there are differences, in the methodology which accounts for the Indian nuances. Uh, this is an important question. Is it feasible to do this analysis by a retail investor? Yes, very much. Nothing here is rocket science. If you just apply yourself a little bit and do up some bit of reading, I'm sure, you will be able to get good insights about this. We are increasingly seeing, this technique being used by the broader market. You will actually notice there are several factor funds today in the market. You have funds on low volatility, you have funds on momentum, you have funds on quality. Recently, when AMC's just launched a multi-factor fund. So I think slowly we are getting there, and you will hear these terminologies a lot, more. Nimish asks which models to use out of the three available on your website. Uh, it's up to you. I use the Pharma French five-factor model plus momentum because these factors are very, very well discovered. There is extensive literature available about each one of them, and I think it's an excellent model to run. But you can try out different models and also compare inferences and the output against those different models. But if you were to just try one, I would just go with the Pharma French five-factor model with momentum added. Okay, I also, there was a question I wanted to just clarify that you can use factor-based analysis for any investment product. So if you have NAV data of a PMS scheme, you can actually compare that PMS scheme's performance against these factors. Similarly, if you have the NAV data for an AIF, you can again do that. So you have your own portfolio. Let's say you are running a direct stock portfolio. And if you were to calculate your own portfolio's NAV, you can actually take that NAV and pass it through factor-based analysis, because it's going to tell you about your own investment style that you have been, following. The rolling, Tushar asks, the rolling factor-based analysis will show how the style is changing over time. Absolutely correct. So for example, here in this webinar, we looked at point-to-point regressions. Point-to-point regressions will, of course, have a criticism that the output is biased by the time period that we have chosen. It's a bit similar when you analyze the return of a fund. It depends on what's the starting and the ending point. So when you do a rolling return, you are able to see the manager's performance across that rolling period, across time. Factor-based analysis, rolling regression is similar. You're doing those regressions in each of those rolling periods, and then you can actually see how has the factored exposures moved across time. Okay. Okay, I think we are essentially, as I see, we have covered most of the questions. I think a lot of the questions are repetitions of what we just discussed. So what I'll do is I'll hand it over to the NISM team. Thank you so much for joining. Hope you had a good session.
Thank you so much, sir, for such a wonderful and informative session. We truly appreciate your time and the valuable insights you have shared with us today. And also big thank you to all participants for attending this webinar. We hope you found this session useful, and thank you all. Have a great day ahead.